You are live.
All right, well, thank you all for coming today. Today is really talking about the market. We have a really interesting market that we're going to be entering into. We want to talk about some of the possibilities of a catastrophic decline, how we're going to protect our portfolio, and what's going on in the marketplace as best we possibly can. I'm going to be trying to be very conscious of your time. This is not an ADRE class. Arizona Department is not involved in it. So raise your hands. We can discuss anything. We can go off the rails if you want. You know, if you see something that catches your eye, just raise your hand and let's just go move forward to it. But we're going to talk about how to protect your portfolio, because we are entering probably into a correction. It could be a severe correction in a multi-decade long bull market, particularly here in Maricopa County in Phoenix, Arizona, Metro Phoenix, Arizona. So I have about 30 slides. I'm planning about 35 minutes. It shouldn't be much beyond that. But we are open to any questions. Now, you all know what's going on here in Arizona. So one of the things that we're most proud of is the 303. Wall Street Journal just did a video on the 303 and what's going on there. So there are 17 1 million square foot warehouses that are under construction right now. And that is just along the 13. Now, of course, it's going to bring all kinds of business coming from California, because it is actually a whole lot cheaper to come from California, open up your plants, warehouse, and distribute from Surprise. If you come to Arizona, you can open up into Texas, New Mexico, Colorado, Nevada, and you can, of course, then distribute back into California. And it's attracting Amazon, Wolf, Sub-Zero, Dick's Sporting, UPS, Ball, Red Bull. These are just some of the things. Nestle's is opening up a plant over there. So this is just going to be one of those places in the country. It's probably the best market in the United States. But this isn't the only market that's going on here. This is one of the things that we see. It's a demographic change, because Amazon can bring their warehouse here. Their workers can buy a house. They can send their kids to school in a crime-free neighborhood, in a great climate, and still make something around $20, $25 an hour, and actually have a really nice life. Unlike in California, they're just absolutely priced out of the marketplace there. This is also what we're seeing over there, is that that the chip manufacturers, so Taiwan Semiconductor has opened up with 8 plants. President Biden was here about 30 days ago, and they have committed to quadrupling that. They're now going to be a $50 billion facility out there, and they're going to put up 32 chip plants. Not only are they building, but there's now already under construction 4 support chip plants that are building chips to support this plant. So the whole area is going to bring in high-tech jobs, going to bring in lots of people with engineers. So this is going to be high-paying, long-term jobs. This is something that's going to be a decades-long trend. So also what we're seeing here is this. The BNSF Railroad has won the bid for the additional 3,500 acres for their 500 they already have. So they have a function of 4,000 acres that they're going to be developing. That is going to be an intermodal plant. They're bringing in rail. They're bringing in freight. It's going to be a multi-billion dollars. And it's going to be not very far from the chip plant. So this is going to open up that whole northwest section of Surprise. Again, lots and lots of jobs, lots and lots of high-paying jobs. And when you start seeing employment, you start getting schools, you start getting retail, you start getting restaurants, and the whole area is poised to explode. Now, we are already been buying this. So we have been buying these properties since 2017, when we started to notice that it was going to start happening for us. So let me go to my next slide here. So here's what's driving it. It's California. If the Californians get their act together, our business is going to slow down tremendously. We see absolutely no indications that they're going to stop. So it is very, very, very difficult to do business in California. Now, California admits to losing 1 million of their population. Their demographics cost 1 million, but that's million net. They've also had 2 million people that have moved to California. Most of those are the new immigrants, and they're taking from the society. So that means that the 2 million immigrants displaced 2 million taxpayers. So being 1 million net, but 3 million taxpayers have left California and gone elsewhere. And we're seeing them coming here to California. And these are these are entrepreneurs, these are engineers, these are people that have got the new, don't have to work in the office, we're going to do it remote. So this is what's happening. They're coming here. Climate, affordability on our housing, and growth. But California is just, they're just doing wonderful for us. We should just keep them going. So they are one of our greatest sources of business. I'm going to tell you that because of all the things that are going along the 202, the 303, and all the growth that we have, we're the #1 market in the United States. We have a generational opportunity that's coming to us in 24 to 48 months. Now, in the meantime, we might have a little bit of a challenge, but in 24 to 48 months, you are going to have an opportunity to buy properties that's going to be a generational opportunity. All you're going to need is a little income, your credit, and a little down payment. And this is poised to happen. Now, in the meantime, we may have just a little bit of problems. So I'm going to tell you that the recession is coming. This morning, the head of the European Union Bank was saying that they're going to reduce interest rates to 1%. That's what they're forecasting. We don't see that anywhere on any of our charts that that's going to happen. We see interest rates going up, getting even worse. We see that our leading indicators are telling us that recession is on its way to us, and we are slowly moving into a recession. It is going to come. So you just need to start focusing your business on the fact that we are going to go into a recession. And here's what we see. So we have two different types of payroll. So you have the BLS payroll, which is the establishment payroll, and you have the household payroll. So the Bureau of Labor Statistics is a seasonally adjusted payroll. And literally, they say we should be about 3.5% unemployment. Therefore, we added about 236,000 jobs. Do you get that? So they're adjusting the numbers to fit their thoughts. So we have a dichotomy. So we have the household survey, which is done by Carpenter and Gray. Carpenter and Gray literally gets on the phone, calls the household. That's why it's called a household. How many people are working in the household? What kind of jobs do you have? How many jobs do you have? And what we're seeing is that we're seeing a huge influx of part-time jobs, and we're losing full-time jobs. And there is a dichotomy between the BLS, the Bureau of Labor Statistics, saying 236,000 household jobs has us actually down to losing 1.5 million. There's a huge, almost it's almost unbelievable, because up here, can you see my cursor does work? So this is what's happening. This is you can see this is from the Bureau of Labor Statistics, and it's just now starting to slow down. We have been watching this. This is following the Carpenter and Gray. So this difference is about 1.5 million jobs. We think there's 1.5 million jobs that are not actually there, that have been lost in the last couple of years. And here's what's happening is that we're getting multiple job holders. So it distorts the statistics a lot. So you have people that are working in 2 jobs. You have a lot of people doing gig jobs too. They're working for cash. It distorts it, but we're seeing everything. Paul, can you make that a little bigger? So you can see the job list. So Michigan, Massachusetts, California are losing population and losing jobs like crazy. I just got this like 4 or 5 days ago. And you're seeing New York, even Texas is starting to lose jobs. Arizona actually added jobs. We're going to be one of the top markets in the country because of what's going on in the 303. Keep in mind that the 303 takes 49% of all the growth in Phoenix is along that 303. If you're not buying along the 303, you really need to start thinking, why not? This is going to give you a tremendous opportunity out there. The schools are great. The housing is very, very inexpensive. We have builders that you can buy a 15, 16, 1,700 square foot single level home, brand spanking new, for $375,000. I think that's actually going to get even better than that. So this is going to give you an opportunity to buy these and start accumulating for yourself along the 303. But now 303 is not the only place. Now, keep in mind, we just had the 202 completed, 8 or 9, 10 months ago. And that's completed loop. And that is opening up all those areas out towards Estrella. It's circling around down the south, and it's going to open up all through Gilbert and Chandler. So going to be lots and lots of opportunities to do this. Now, here's the problem. This is an absolute problem, is that the liquidity in the system is being drained and drained dramatically. We've never, ever had this little liquidity in the marketplace. When I say ever is a really, really long time. It's never, ever had this little. This is what's causing the banking problem, is that they have assets. If you came to get cash, they don't have cash. And the Federal Reserve is not adding cash to the system. They're actually draining the system. They drained $1 trillion. They're draining $90 billion a month, which is $1.08 trillion a year they're taking out of our economy. This is pervasive. Now, this is all across the globe. This is what caused the problem with Credit Suisse has been going down for a long time, but a lot of these other banks. So let me just get to the banking, and let's just take a look. Here's where the problem that we see. So last week, the Federal Reserve put $300 billion into the liquidity. And you think, oh, hooray, we got $300 billion. This helps. It didn't go anywhere. You notice that the Swiss National Bank backstopped Credit Suisse for, it was UBS, they backstopped UBS for Credit Suisse acquisition. They gave them $100 billion. That $100 billion came from the Federal Reserve, because 2 weeks ago, the Swiss National Bank, the Central Bank of Switzerland, came to the Federal Reserve and asked for money. They got $60 billion. They just pledged $100 billion to UBS so they can buy Credit Suisse. They got that money from the Federal Reserve. They did not have the money themselves. So of that $300 billion, $160 billion went to Swiss National Bank. The Central Bank of Switzerland got that money. And you saw Deutsche Bank took another $60 billion. So this is not into the economy. It's in the banks, and it's there to add liquidity. But this is a problem because we don't have money. We were just talking about the fact this goes into underwriting. When we start losing liquidity, they don't have much to lend out. If they don't have much to lend out, they get to be very particular who they're going to lend the money to. And when they start restricting the amount of cash flow going out, our business starts to falter. And that is what we're looking at. So I see that we're going to have very slow. I'm getting ahead of myself here. So let me just take a look at this. So here is part of the series as to how this went. So Silver Bank announced bankruptcy in 1 month. So we got Silver Bank went out March 18th. Silicon Valley Bank was taken over by the FDIC. Now, Silicon Valley Bank had assets. They bought a bunch of fixed assets. Now, we've been telling people to get out of the bond market for almost 3 years because we saw the bottom of the market. We saw the bottom of interest rates 3 years ago. When you buy bonds and you have long-term fixed rates like the mortgage guys, you have Ginnie Mae's and you have a portfolio of 30-year fixed rate mortgages at 2% and 3% on your books, and interest rates go to what, 6.5%? Is that right, Kyle? 6.5%. That devastates your presentation. That devastates your portfolio. That's what happened to Silicon Valley Bank. They thought they were being very, very safe and secure by buying long-term bonds. Interest rates go up on long-term bonds, devastates their portfolio. Now, they also made a couple other mistakes. They understand that they had their risk portfolio model went red, and they went and changed the parameters so it wouldn't run red. Well, that's not good business. But that's what's happening with Signature Bank. They have a lot of portfolio that is really at risk. They don't have assets that are saleable. We have First Republic Bank that is just on the cusp of going down. So we have to be very, very careful with that. And Credit Suisse, of course, has been in the news. Credit Suisse has been tottering for a number of years, but Credit Suisse is a systemically important bank, and that went down. Very, very similar to what happened when you had Lehman Brothers. And you guys remember that. So Lehman Brothers was a systemically important bank. Everyone said, well, no problems, if this is contained. Well, it's not contained. So we need to, as investors, be very, very cautious. Now, I'm not saying don't buy. I'm just saying be very cautious. Now, these are the banks that you can see. Yeah, you can see these people sitting at untenable levels of unrealized losses. So these are securities that are available for sale, and are available at losses. So if these banks have to come up with liquidity, they have to sell these assets. So they would have to sell these assets at losses. That's how they go from being solvent to not solvent. And we have a whole list of these banks that are happening. We're in a transition from going from low interest rate to high interest rates. These guys are supposed to know better than this. But the model said if you have a whole portfolio full of U.S. Treasuries, how secure can you be? Except what happens is that portfolio takes an absolute devastation when interest rates go up. And we've raised interest rates at a historical level. They've never rapidly gone up this fast before. So these banks are at risk. You need to be very, very careful if you're doing business with them. You can see First Republic, like right up on top there. So we have $7 trillion in uninsured deposits in the United States. Now, I'm going to tell you, I've heard all kinds of people say, well, they should only be insured for $250,000, and anyone over that, they should take risk. Well, where in God's green name would Equity Title put their trust account if they could only have $250,000? Can you let Equity Title have their trust account at risk? How about Home Depot's payroll? These people need a place that's secure that they can use for a commercial, and they cannot have their deposits at risk. One of the reasons that we're having problems with the U.S. dollar is that the U.S. decided that they were not going to honor international law and went after Russian assets. If just because you're Russian doesn't make you an opponent. So if you're a Russian businessman, you have have $500 million in the bank. The U.S. government went after it. They took yachts, they took assets, and of course, no one wants to park their money in U.S. dollars anymore because they're afraid that we're going to take it. So this has been a real problem with our currency. Now, I'm going to tell you that some of these banks are in trouble. Some of them are not. It depends on how they've positioned their portfolio. Most of our banks, so when you look at Chase, perfectly fine. Wells Fargo, perfectly fine. Bank of America, perfectly fine. Citibank, perfectly fine. The ones that are going to have problems, of course, are going to be the regional banks. What do the regional banks provide?
Financing for the local community.
They do. So almost all of your industrial and commercial loans, because they're local, come through the regional banks. And when these guys don't have liquidity and when their portfolio is at risk, guess what they don't do? And we're already starting to see some of that happening as we speak. So now I'm going to go into some of our research. And again, I work with Charles Nenner, so I have a lot of his information. But I am going to tell you, we talked about this 3 years ago, that interest rates had bottomed. They weren't going down anymore, and they were soon going to go up. Now, if you just look into the charts, you see that the 10-year Treasury has broken the trend line very, very convincingly. Now, they don't go up in a straight line, but they do go up. So our projections is for much higher interest rates. Now, we also have a projection that we think that we've got a reduction in rates. So we have a retracement in rates from, really until probably end of April into May. By June, we should be done. So you just have to be careful with that. And that doesn't necessarily mean it has to happen, but we're looking at probably June before things really start to snowball down. I'll go into our research a little bit beyond that. So let me go on my next slide here. So you just know that everybody buys payments. So as interest rates go up, prices go down. Affordability goes down. If you cannot afford it, this price, you can afford it at a lower price. It's going to change the market. The market is going to go down. Now, we do have some demand. So if you're in New Jersey, or you're in New York City, Minneapolis, if you're in Milwaukee, Chicago, Portland, Los Angeles, and San Francisco, you are certainly at risk. Prices are going to come down. We've already started to see this in San Francisco, all throughout the Bay Area. They're not coming down just a little bit. They're coming down significantly. Now, here in Maricopa County, probably not so much. But I think the appreciation probably has certainly slowed here. I don't see. I know that there's there's a lot of research saying that we think that we're still going to go up 4 or 5%. Don't see that happening. I think we're going to stay relatively stable. So unless we see a huge, unless the Federal Reserve throws in a towel, if they go down to 1%, then we're going to see inflation go off the charts. I don't see that happening, but if it does, I'll alert you to that and say our research is doing. Our research shows that they're going to continue doing what they're doing. Now they may pause, in which case we may have 5.5%, 6.5%, 7.5% rates, but we see them, and we see inflation coming back later in the year, and that's probably due to the U.S. dollar declining. So here's what else we're seeing. So we just talked about underwriters. We talked about being at the regional banks. We're seeing that underwriters are becoming very, very concerned as to who they're lending money to. They want to check credit. They want to check your abilities to repay. They want to look at your project. They have less and less money to spend, which means they're going to put less and less money out, and they're going to be very, very particular as to who they do that with. That acts as a brake on the economy. So not only do we have a whammy of interest rates going up, we have the double whammy of now that we've got restrictions on underwriting. That is just a fact. That is just going to come to us. So we're going to see that, and it's going to slow the economy down. So that is part of our presentation. So Dr. Schiller was just on at CNBC this week. I don't know if anybody saw that. He thought that rates were coming down. That's pretty unusual for him. He normally doesn't say anything, and he thinks that we're going to see home prices decline a little bit. That's also on our. We also think home prices are going to come down. So this is on a national basis. So remember, I'm talking nationally. So nationally, we're going to see home prices nationally come down. Phoenix, probably some. Nowhere near as what's going to happen in other markets in the United States. However, just got this from the National Association of Realtors, and it's from January 22 to January 2023. That's the trouble with some of our data is it's always lagging a little bit. But this is coming out of NAR. We have seen a sales drop. Fairly significant sales rise. Less, of course, in the lower prices. Under $100,000. I mean, it's not so terribly bad. But when we start getting up to the $1 million price range, it's 41% price drop. Now we're hearing from Las Vegas that they're down 45%, and I've heard from some of our title companies here that we're up to 50% sales drop. Now I understand we don't have that many houses for sale. We're fortunate that the listings are down, but the sales are dramatically down. So I think we need to brace ourselves and look at this. This is from S&P Core Logic. San Francisco from the peak is down 17%. So if you bought a $2 million house in San Francisco at the peak, that means you've lost $350,000 of value in 1 year. Most people don't, they put 20% down. Most of your payment is gone. So it's San Francisco, Seattle, San Diego. Phoenix is part of it. So we've lost about 10% per Core Logic. And Las Vegas, 10%. We've seen that. I've seen builders that were selling for $450,000, and they're coming back and saying, look at, we'll take 10% off. I mean, we've had it here in our office. We've had people that have lost the transaction because the closing is $440,000, and they refuse to do it. And then a week later, they say, well, would you come back? We'll take 10% off. We'll take 50% off. Last Christmas, I had a builder offer a $105,000 discount on his property. And the builders are scared to death. Scared to death. First off, none of the bankers are going to want to give them money. Their lending lines you have to know are going to be restricted. They're going to be starting to slow. Their buyers are canceling on them because what happened with affordability? We went from 2.5%, 3% to 6.5%. So our house payments went up $1,000 to $1,500 in a declining market. Scares the bejeebies out of people. And the builders have thousands of homes coming up for construction because they've had nothing but supply problems. So they're scared to death, and they are going to start discounting. Now, there is an opportunity for all of us. If we just start looking at the builders, they are going to put them on sale, and they're going to try and get rid of whatever inventory they have. That inventory is only going to be available while they have it. They're not scraping the ground. They're being very, very careful as to what they're selling, and they are trying to restrict their inventory. So once that inventory is gone, they're going to be a great sigh of relief. but we're not going to have it anymore. So there is an opportunity for all of you to take a look at that. Because yes, they're a little far out, but you can buy a brand spanking new home for $370,000, $375,000, which stays probably pretty good. And I think the rents, we'll talk about the rents, but I think the rents will probably stay fairly good. Now, here's where I think most of the problems are going to be. It's going to be in the commercial and industrial space. Offices probably going to just take it right on the chin. Multifamily to a little bit because of restriction in money. But I just got this slide like last week. So KBS REIT bought this building in 2010. Now, does anyone remember what 2010 was like? 2010 was not a good market. It was a terrible market. And they bought that building for $228 million in a really, really down market in 2010. And they just sold it 13 years later for a $118 million loss. Now, do you realize how bad that market has to be to lose $118 million from a property that you bought really basically distressed during one of the worst real estate recessions we've ever had, and to lose it again? And that's because the cities are becoming very, very difficult to do business in, just like in California. And this morning, I just saw this morning, this is just absolute. Whole Foods in San Francisco built a flagship grocery store, like 50,000 square feet, just an enormous place. It had 1 year, they're closing it because it's crime ridden. They're afraid for their employees to come to work. Now that building is brand spanking new. They're going to have to pay for that, and they're closing it down. And that is going through all of our major cities. So if you're in Detroit, Baltimore, Minneapolis, Chicago for sure, San Francisco, you're having lots and lots of trouble. You don't want to go to work. And now we've got this remote system in place. Well, we don't need these office buildings. So a lot of these office buildings are just going to take it in the shorts. So look for that. I think a lot of the REITs have already started with this. So KBS REIT is in trouble. I think you're going to see also we saw with BlackRock. I don't know if you looked at BlackRock commercial REIT, and it's down 45%. So that's a leading indicator for you. These guys are professional. They know exactly what's going on, and they are in trouble, and they've lost 45% on their commercial properties. And this is what we're seeing in multifamily. It's not necessarily a rental problem. It's a financing problem. Now, in price, we've seen a 13% price decline across the country. 13%, not so much here. We're thank goodness we're here in Metro Phoenix, but across the country. Now, I'm going to tell you, if it happens in Minneapolis, we're still going to feel the ripple effect here. If you have investors that have multiple properties across the country and they're losing millions of dollars, they're not real excited about buying properties. So you just have to realize what's going on. So we do have a 13% price year over year already that's happened. We see a sales decline of 74% nationwide in small apartment buildings. 74%. Now across the country, we have the largest amount of apartments coming to market we've ever had, literally in probably the worst market to do that. Always happens. You build because it's so good to make so much money, but everyone forgets that there's a time lag. And so we have 500,000 units across the country coming to marketplace in probably one of the worst markets to do that. And that's the most in 40 years. So here in Phoenix, I think we're 25,000 units that are coming to market. And these, of course, are A units. These are all with all the lumps and all the glitter and the shiny stuff that's in there, and they're the ones that are going to want to make the most. So we're going to talk about that for here just a second. Now, this is coming out of research, so I want you to pay close attention. This does not necessarily have to happen, but I think it will. So this is when we use symmetry in a bubble. So everything seems to always go back to where it was. It retraces back to the mean. Now, this was wonderful research by Charles Hugh Smith. He's talking about the bubble symmetry in the .com. He went back and back tested this, and you can see the symmetry to this. So this is exactly what happened. It went up, it bounced a little bit. If you see here, this is another peak. So this is peak 1, and these two really would be peak 2, and you have a waterfall effect, and then down you go. But they symmetry. They retrace back to the mean, and that's from the .com. So this is what he thinks is going to happen with the S&P, because awful. When we put $10 trillion of liquidity into a marketplace, what in the world do you think is going to happen? $10 trillion. Everywhere you look, you're going to see this pop. In every asset class, we have this pop. And this is what's happening. He's extrapolated out and done the retracement. He thinks that we have probably cut in stone about a 45% decline total from top to bottom on the S&P. Thinks it could go down to 55%. Now, I'm going to tell you, a lot of my clients have a lot of money in the stock market. You do not need to be invested 100% of the time. You don't need to do that. So you can talk to your financial advisor and see, where can I hide? You don't need to be exposed 100% of the time. So we are certainly at risk. Now, you see how these go up? You see that they bounce around a little bit? There is not a straight line. So they come up, they go down. You can actually, if you're really good at this, you can trade this. You can actually make some money in markets like this. However, the direction is probably down. And as we unfold the marketplace, this will get more and more stringent. Let me go to the next slide. This is one that we're most concerned about. So he's done the housing. That's us. This is going to be on a national basis. So his symmetry, he thinks we have at least a 30% from top to bottom decline. Now, we've already seen 17% in San Francisco. San Francisco could probably go 35 or 40%. They're so overbought there. They might go 50%. But nationwide, this is not good news for us, because it's going to take a lot of capital out of the marketplace. A lot of your investors are not going to want to do this. But we make it a 60%. I think this is personally, my research doesn't show that we're going to get a 60% retracement on this. And that would take us all the way back. That would be like a Mad Max event. We've really had some real problems. We've had a lot of liquidity. We haven't had any liquidity put in. So if they don't restore the liquidity, we could go down there. But we have at least a 30%. Let me go to my next slide, and I'll show you why I think so. This is my research. If you've come to my classes, you've seen this. This is a stylized version. There's actually this peak. There's actually two peaks. We're actually hitting into the second peak. So the first peak was March 2022. First peak. Most important peak is the first one. That's when you have all the momentum. That's where you have all the enthusiasm. That's where you have all the craziness, all the exuberance. First peak, March 2022. We're going into the second peak. Second peak is the last peak. And we are up to here. If you look at this if you look at his and look at mine, they look kind of similar, So there are two different methods coming to the same conclusion. So I want you to pay very, very close attention to this. So I think that we are completing, this is stylized, I think we're completing the 18-year cycle, which means that we're very, very close to the top. I don't see appreciation much more at all. Now, I have a huge portfolio. It's taken me a long time to put my portfolio together. I like getting $15,000 to $20,000 a month, every month, from my portfolio. Your investors will like the same. What do you do when you have $100 million out there and we're looking at a declining marketplace? How do you take care of this portfolio when your portfolio is at risk? Now, it's the debt, first off, that's going to be the problem. It's not going to be the property. It's going to be the debt. So you need to make sure that you get your debt under control. If you've got a chance to refinance in the next 4, 5, or 6 weeks, I would certainly do that. So I think you're going to have a very, very good opportunity to get a lower rates. Now, if you're at 3.5%, I don't think I'd be refinancing that. What a great asset that is to have on your house, a 3.5% loan. What if you had a 3.5% FHA? Holy cow! What a great deal that is. So what do we do for our portfolios that are at risk? Here's the most thing. And we make fun of this, but people don't pay attention. The fuse is lit. We're looking at it happening right now before your eyes. And once it gets down here, as they say in the cartoon, not much happens at first. But the fuse is certainly lit. So let's go on to this. So you need to start thinking outside the box. what are we going to do to protect our portfolio? I sure don't want to. I don't want to lose everything I've got. That's not something I would like. So we start thinking of an integrated asset approach. So we want to start thinking outside of our real estate. This is where you need to have a good financial advisor that you're working with, someone in the financial business, because we can do several things for this. First off, if you've got a portfolio that's at risk, you can hedge that portfolio. You can get into some inverse ETFs. So when the stock market goes down, the inverse ETF goes up, and you can hedge your portfolio. So if you lose money in the stock market, you make your money up in the ETF. That is just a really good, easy hedging strategy, easily done. All kinds to choose from. Just need to talk to your financial advisor to do that. And in our business, we have all kinds of inverse ETFs for the real estate business. So you can take these REITs and actually short them, or you can do an inverse real estate ETF and protect your portfolio. So if you see the real estate business start to go down, your ETF will go up, and you can hedge your portfolio so that you don't take that huge gain. Because when you have properties, you're still getting principal reduction. You're still getting cash flow. You're still getting tax advantages to these. And if you get rid of them, now you're starting, and you still need that cash, you're starting to use your capital. So lots of really good reasons not to sell your portfolio. And we only have a 2 or 3 year jeopardy period here. So you don't want to sell a portfolio that you've taken 10 years to put together, because we've got a couple of years of bad marketing. Because this is just something we go through. This will be the 4th time I've gone through it. We go through it, we come back on the other side. So you can talk to your financial advisors and do this. It's very, very inexpensive. You can also short the equities of Toll Brothers or Lennar. You use Toll Brothers or Lennar as proxies for the real estate business. So when real estate goes down, I'm going to tell you Toll Brothers is going to take a hit. So is Lennar. And when they go down, if you short them, you're going to make money. You could also buy out of the money puts with them. So that is just talking about using another asset class to protect our asset class. Now, I think that the market is going to recover. I think that we're going to have what I'm calling is a BlackRock event. So BlackRock has put together $52 billion in cash waiting for the cycle to complete. Right now, they have $52 billion in cash, and they want to buy single-family homes as soon as the buying opportunity arises. And that opportunity is looking at you probably within 15 to 24 months. All you need is some income, a little bit of capital, and keep your credit good. And you'll get probably one of the greatest buying opportunities we've had in 18 years. It's coming right away. So I want to thank you very much for listening to me ramble on here. Any questions in the market? Anyone have any thoughts? BJ?
Well, so when you pointed out the difference for the banks, let's say Silicon Valley, they knew probably 24 months ago what was happening with the interest rates and where their spread was working at the time. Why did they do any corrective measurements at that time, or did they have more of a wait and see attitude?
Yeah, it's a great question. You know that they just had the top 4 auditors were in there and gave them a clean bill of health March 1st.
Incompetence.
Yeah, like 2 weeks before they collapsed, they gave them a clean bill of health. Doesn't make sense to me, but they used the model, and it's coming out that the chairman or the president actually changed the parameters of the model. You know that there's an inverse relationship. If you own long-term bonds and interest rates go up, it just decimates your bond portfolio. This is just all the pension people know that. Okay. Yeah. Bill?
You mentioned 15 to 24 months. Is
Yes.
that when BlackRock is actually thinking of starting to buy then, or do you have to know?
I don't know. It's just what my timing model shows that we should get I think I shared that with you. The timing model shows that we're going to start seeing a decline, a noticeable decline, by the time we start approaching the 3rd quarter of this year. So by the time we get into fourth quarter, it should be very, very evident that prices are starting to decline. And in the last three that we've had what we call a waterfall event where things just collapse. Now, and I think they're already starting to collapse in the commercial space. I mean, to take a 50% decline on a 40-story office building, I mean, that's just awful. So you start to see that. So it just has to do with timing. That is all that BlackRock is waiting for, is just the time for entry to it. They just know it's coming, and so we know it's coming. It's good for us. You can make a fortune doing this. You just have to be aware of what you're doing and protect. You got to protect your income. Look, we're in sales, right? So you need to make sure that you've got income coming in for yourself. You know, you got to protect your credit. That's easy. Just pay your bills. You're going to pay your bills anyway. Make sure that you're paying them on time. You can work with the finance guys and make sure that you're getting full credit, so that you can keep your credit up. And then you just need some down payment. And again, you know, if you come into our conversion strategy, we'll be more than happy to talk to you about that. Yeah, go ahead. Question.
So I just kind of heard this buzz, and I don't know much about it, but somebody was talking to the Saudis, and some couple are talking about a world currency versus and getting the U.S. dollar out. Has anybody heard anything about that? Have you heard anything about that? I mean,
Yeah, it's on our charts. So there's a strong possibility that the U.S. dollar, you know, everything cycles. You know, everything goes up and down. Nothing just goes up and stays. So in 2009, the U.S. dollar on the DXY, and the DXY is a basket of currencies, was valued at 0.72. Right now, it's 1.02. It was 1.2 not too long ago. So that's a huge difference. That's a 30 or 40% decline. So if you have the U.S. dollar drop by 30%, what do you suppose is going to happen to the price of oil? Price of wheat? Price of lumber? All those, you know, because we're the world reserve currency, we're enjoying the fact that our currency is very, very strong. So we lose the strength in the currency, then we have to pay more for everything, which is why we see inflation coming out in 2 or 3 years. So we're kind of in a bad situation, is that we see prices of homes coming down, but we see inflation, severe inflation coming. We don't know why. It's just on the charts. I don't know why. This is my extrapolation, is I think that that's going to happen. One of the reasons I can see is that the U.S. dollar collapses, and you can see it happening. You know, I think it was a terrible, terrible mistake for the U.S. dollar, the U.S. government, to go after assets of Russian citizens. You know, we're not at war with Russia, and how can you legitimately say you're going to take this billionaire's $500 million out? You know, how can you do that? And they've gone after their bank accounts and their assets, and so if you're a Russian and you've got $1 billion, are you going to put your money in U.S. treasuries? How about China? They've got $1 trillion in treasuries. Do you want dollars? Probably not. So what you're saying has some validity to it. You know, so, and if that happens, we're going to see inflation. So in one way, you have to be careful what you're buying, and on the second half, you have to buy to protect your purchasing power. That's why I'm saying that you need to hedge your portfolio, because lots of nice things happen in a portfolio. Which, you know, it's nice having $10,000 or $15,000 coming in each and every month on our portfolio. So we're not necessarily so concerned about the value of the property as much as the income. And I think what's going to happen with rental, because everyone needs a place to live, right? Everyone needs a place to live. So your choices are pretty limited. You're either going to buy a place or you're going to rent a place. That's it. And if buying starts to slow down, rentals speed up. So last time we saw a migration from A properties to B properties to C properties. And they said, well, the price of rentals came down. Well, yes, the price of what people were paying came down, but the B properties did not depreciate. They didn't lose 20 or 30%. What happened was people went from A paying $2,200 and they went to B paying $1,800. That's what I think is going to happen. So having these rentals should be a very, very good idea. Any other questions? Oh,
Is there any risk to treasury bills?
I don't think so. You know, so treasury bills, so we've got bills, notes, and bonds. So bills, you can ladder bills like 30, 60, 90 days. I think it'd be very good. And I think you can get a 4%, 4.5% return on it. So really, really nice strategy to do that. backed by full faith and credit of the United States. So I think those are really, really good. And you own them. So if Schwab went down, you own the bills. Schwab's just holding them for you, but they belong to you. So unlike the bank, the bank, you give them the deposit, well, it's their money. We owe it to you. Unlike if you go to Schwab, I own that security. So yeah, it's a
concern. If you're sitting on a pile of cash, that's a real concern of getting it attached.
Yeah.
Or attached.
Yeah, I think you should be. So look at privately tell everybody you should have food and water at home. You should have 2 or 3 months worth of food. You should have 3 to 6 months worth of cash. So that you can get, in case the banks are closed when you go to get there, that you can buy gas. You can buy gasoline because your credit card probably won't work. So you want to make sure that you've got small bills, singles, 5s, and 10s and 20s. You're not getting anything at Chase is giving you what, 1/4% of 1%. You might as well have it at home. Just don't tell everybody I've got $20,000 in my, and it's in the refrigerator in the back. It's in the ice cream container in back.
Where do you live, Michael?
Yeah. So I want to be very conscious of that. So look, we have people that helped us put all this together. We are going to go through. I think we have really, really good spring market. We're going to summer. I think we'll start seeing things slow down. I think by the time we get to fall or winter, we're going to really see the difference in the marketplaces. In the meantime, our sponsors really need your help because business is down 40 to 50% for them too, and they need your help. They need you to supply them and to help them along with all this stuff. We have a team that's all good. You guys want to stand up and introduce yourselves so everybody knows Robin?
Yep. Hi, everybody. I'm Robin Brand with Home Guard Home Warranty, and I have provided the placemats this morning right here. And there's some nice goodies in here. An excellent 13-month home warranty plan, a notepad, pen, and then of course you get me. Evenings, weekends, holidays, please call me. Houses don't care what it is when it breaks. So anyway, thank you for coming today.
I want to say something on behalf of Robin. I have been with her, not at this company, but with Fidelity. She does wonders. Even if you don't like the company, she's going to get it taken care of for you.
Thank you very
You're
much.
welcome.
Yep.
Well, I appreciate it.
All right.
My name is Bill Denhart. I'm with Valley Building Inspections, and we're a team of 7 inspectors. It's been serving Greater Phoenix Valley since 1994. Any type of deals that come across your table, we can inspect it for you. We're luxury specialists, new construction specialists as well. 80% of what we do is still in the resale market, but we're starting to see more of those multifamily commercial units pick up too. So we're still booking out within 48 hours. Give us a call. All of your ancillary services we'll take care of under one roof as well. Sewer scope, environmental, air quality, termite, the whole lot. So we'll show up for you and your client. We enlighten, not frighten, and we want to get the deal done with you, not take the oxygen out of the room. So
Bill, I've had just this week people closing on their new homes, and they said, "Man, we want to do an inspection." I mean, they've been out there looking at themselves, and they said, "You know what? We got to get someone out here to take a look at this building."
Yeah.
Are you seeing a lot of that?
Yeah, absolutely. And engineers love us because there's a lot of items in the inspection report that kind of needs to get a little technical. And we have a service right now called Repair Pricer that helps make a lot of sense during that Binzer time period where you need to track down that HVAC guy in the middle of July. You're looking for credits versus repairs. We have a program that will basically, fast track it for you on either side of the deal. So yeah, absolutely.
Yeah, I think it's a good idea.
No,
I think a
yeah.
builder would like that too. You find all stuff, they just soon get their subs to fix that before they close, huh?
Yeah, absolutely. And I think people are starting to realize during those 3-day contingency periods not too long ago where people were waiving the inspection, they're like,
Oh.
oops.
Yeah, it's a
Right?
problem.
So,
Yeah.
yeah.
So, you have to do what you got to do, but
Absolutely. So we're seeing a lot of those types of inspections as well. So yeah, I've got a card. Please come say hi to me before you leave. Okay. Thanks.
Hello, everybody. I'm Shandy with Equity Title. I'm here for your escrow needs. We do have our Equity Advantage program that we offer 50% off of the escrow fee for listings, and both the buyer and seller get that. We're also here to help you. We're an extension of you. We can run reports for you, leads for you. We can customize your anything that you need for your listings. I have cards as well. So, And Michael is amazing, let me tell you, I love coming to his classes.
Yeah, well, you do take good care of me.
I did something nice for Robin, so I have to say something nice for Shandy. Shandy, I work with her even at security head. She'll go out of her way to call you at night. Don't call her every night. But she's there for you too, just like Robin. She's great. So I love her. She's always helpful.
Thank you.
I'm Kyle People with
And
Guaranteed
they
Rate.
paid me to, I'm sorry, they paid me to say that.
I'm Kyle People with Guaranteed Rate Affinity. I'll say something nice about Shandy too. Because we work with Equity Title all the time, so they're a great company to work with. Shandy's great to work with if you have the opportunity to get them on your contract.
Thank you.
But I am the sales manager for Arizona. We have a team of 31 across the state. We're in the lending business with a whole suite of products, competitive rates, fees. And one of the things that you brought up that states that you see people exiting, we're seeing that too. And if you can get a hold of those investors that are selling their properties and moving, those are some sweet deals because they usually come over. They're still investing in Arizona. They come over and they usually buy in 3 or 4 packs because the one property they sell, they spread it out across Arizona. So
We
that's
love that.
really, if you pop that slide up and review this and see what those states are, if you can market to those investors. We're seeing a lot of that. We have some great products geared for investors to really streamline that process. Just an appraisal and a credit report and assets for approval, and it's easy deals, and usually they come in multiples. So,
Well, thanks, Kyle. And you open that up for Paul.
I'm Paul Lowe with West USA
Oh,
Realty.
2 Pauls.
I do a lot of property management as well, so if you have any property management needs, I'd be happy to help you.
It's the guy. It's the guy.
And we have the other Paul.
Hi, I'm Paul Loganson, financial advisor. I specialize in Delaware statutory trusts, which, if you're not familiar, it's investment properties sell. They do a 1031 exchange. If you don't want to own an additional property, you can be a passive real estate owner with a Delaware statutory trust.
And what happens and Paul is kind of the fallback guy, plan B, if you have a failed 1031 exchange.
Correct.
So Paul gets a lot of that. So you really need to know him. If we're doing 1031 exchanges, what we don't want in a 1031 exchange is a failed 1031 exchange. So, hey Maggie, how are you? So Paul is our guy. So I need to plug too. So tomorrow we've got the agency. So agency, that's a CE course. I cannot go off the rails too terribly much, but we will talk about what's going on in the marketplace as well. We'll talk about your responsibility with the Arizona Department of Real Estate. Today we were talking about investors. And also I just got approved for tax advantages for real estate investors. And that is it's a CE course, but it is going to be a certified real estate investment advisor course. So it's going to be very intense. It's going to be not for beginners. So if you want to do that, that will be credit towards your designation for that. And we're going to be putting that together and on the calendar. So if anybody wants that, we'll be more than happy to talk to you about that. Maggie, you're back there. Thank you very much for helping us with this.
Oh,
Any other questions that we have? Jim, you have any question?
I actually have a question, because I'm on the other end of it. How can a 1031 fail?
If you have a 1031 and we've identified a property and we're in a closing transaction, we find out that 1031 property we've identified can't be sold.
Oh.
There's something going on that we've got problems with title. We've got some kind of problem with and these things happen. I mean, it doesn't happen all the time, but they do happen. So if we're talking about $1 million or $2 million, this can be a very sizable. Look at if you bought a property 30 years ago, which I've got properties I bought 30 years ago, they got a very sizable capital gain in there. And we're talking about a very penalizing tax. So, and then Paul comes right up and does that.
That's interesting, because I have a client, she bought here, but she also sold a property in Washington. She didn't do the 1031 exchange. She just got hit this year with taxes, and she was just floored by what she owed.
Yeah.
So she didn't want to buy another property. She's elder, she's getting older, and she's like, I don't want to, and she got nailed, but there's a place where she could have parked that money.
Perfect client for me.
Okay, all right, I need a card.
get this card, yeah.
Yeah, perfect client. Yeah, absolutely,
Okay.
positively. So I've got 5 minutes left. I'm going to try and be real conscious of you. And Paul has been doing our rentals. And I think the rentals has still been very strong, have they not?
Rentals are good.
What do you?
Good answer.
Any other questions for anybody?
You said something about a designation.
Yeah, so we're doing a certified real estate investment advisor designation. So you need to take real estate investing for beginners. That's a required class, and then we have other classes that you can take. So I've been working on this for a long time, and the Arizona Department of Real Estate has given me a CE for it. So not only do you get to take the class, it's going to be tax advantages for real estate investors. We're going to talk about 11 different advantages that you have tax savings on there. Like I'm working on. I'm just putting a verbiage together. It's just that, when you talk about the tax laws, they talk about installment sale. Well, installment sale is different from the tax than what it is in real life. So, so IRS defines what an installment sale is, but if you transfer title, now it's no longer installment sale, it's seller financing. And that's a huge difference when you go to taxes. So when you do an installment sale, you're taking money on an installment basis, and you only pay tax on the money that you take. If you do seller financing, you're taking, instead of getting cash, you're taking a note. Okay? So that note now becomes taxable. You now have a capital gains because you have a transaction that's taken place. So you haven't done an installment sale. Yes, you're not getting all your money, but it's not an installment sale with seller financing. So there is a huge distinction between that, and makes a big difference in your taxes. Yeah.
Okay, because I found out this financing agreement that it was you were taxed on the event. You got your income.
Correct.
And you were taxed on that.
Yes.
I didn't know you were taxed on the entire sales amount.
Well, you're taxed on you have an event. You have a tax event, right? So whatever your obligation is, you're going to be taxed on it.
Okay.
So when you do an installment sale, what we want to do is we are deferring that and taking it over the length of the contract that you do it. And it's a distinction that you need to make.
So an installment sale, I'm not clear on that. What's the difference between that and asset bank? I mean, like a seller finance agreement.
It has to do with you don't transfer title. You transfer all the executory rights to it, but you still own the title. So title doesn't transfer. So
the seller still owns the title?
Seller still owns the title, but all of his rights have transferred to the buyer. Buyer gets, he gets tax write-offs. He gets the interest write-offs. He owns the property. If there's a fixed sale in time, we just haven't transferred the title. So that's just a distinction. So we're going to talk about that, and that's a really good point, because it makes a huge difference whether you do an installment sale or you do a seller financing. Because if you do a seller financing for $1 million in gain, you're going to pay on $1 million in gain. If you do a installment sale and you only receive 20% down and the rest is still in escrow, you're only going to pay on that 20%. And you can actually defer that too if you wanted to, because we can do some other things.
So on $1 million sale, so you say the SFA, you take a seller finance agreement. An SFA, on that sale, then you would be, so it's $1 million sale. Say you have a gain of, I don't know, $300,000 or something like that. So you would be taxed on that $300,000.
You'd pay on a portion of it, 20% portion of it.
You pay, okay.
The actual value that you receive.
The actual value you receive. Right. And that's the distinction. We're going to do a class on that, Jim. So, this probably isn't the right venue for it, but yes, and that's where the confusion comes. So I'm being told it's 11 o'clock. Thank you so very much. Any other questions? More questions?
Michael, did you talk about the class tomorrow?
We have class tomorrow. Yes, we have agency tomorrow.